Why is your credit score important? You always hear financial experts saying how important your credit score is. A few years ago, this was not always true. However, recent economic events pushed this figure higher into the priority scale in your financial life. Your credit score is important because of so many things. If you want your personal wealth to grow with the least amount of investment on your part, you should consider monitoring this score to achieve that. If you intend on taking out a loan, a high credit score will benefit you through the interest rate that you will be given. Bottom line is, if you have a bad credit score, you will end up paying more interest on your loans. An example is probably in order to help you understand the expenses that a high and low credit score can cost you. Let us assume that you want to refinance your home. In a cash refinancing table, credit scores have the corresponding points to pay off on top of the loan. This is analyzed in relation to the loan-to-value ratio. For instance, the amount that you need is $250,000. And you have an 80% loan-to-value ratio. If you have a score of 659, you will be required to pay 2.25 points, which is $5,625 on top of the loan amount that you will get. But if your score is 20 points higher at 679, you only get to pay 1.5 points. That amounts to $3,750. That is a difference of $1,875. Imagine if your score is 700, which would mean you only pay off 0.75 points, which translates to $1,875. With a 41-point increase, you get to save $3,750. You also have to think about the people who will look at your credit score, because it basically represents your financial reputation. Aside from lenders, there are other people who are interested in your credit score. These people include investors, employers, landlords, and even potential business partners. So if you want to save up on interest rates and ultimately increase your financial opportunities, then you should consider raising your credit score to better your chances.